talk about short positions. Short positions, in general, can increase your profit opportunities because you can profit from stocks that are going down. So it kind of opens up your universe of trading possibilities. And obviously when you're in bear markets, that's what you want to do because you can profit from bear markets. So you always want to be ready to take short positions in markets so that you can profit if you go into a downturn, and especially a bear market where if you just took long positions, you can get pretty hurt. So you want to think in terms of short positions to help reduce your risk and to increase your profit potential. So over the last 10 years, the S&P index has had a negative return. But if you use the major trend system to trade the S&P, instead of having a negative return, you would have had a positive return. So you would have had, over the last 10 years, 193% return instead of a negative return. So that's just an example of how you not only had more profits, but you also reduced risk and you avoided the loss over the last 10 years. So short positions can reduce risk and increase your profit potential. Now, the three key things you want to keep in mind for short positions is you only want to take short positions when the major price trend is down. The 1 month and the 20 month is down. I've learned this the hard way because I've taken short positions using the 50-day and 100-day only to be stopped out. And once I learned that it's better not to take the position unless the major price trend is also down. So I would take a short position in some stocks and the major trend would be up, and I would get chopped up because there'd be a counter trend rally and it would knock me out of the trade. So you want to make sure that the major trend is down. And then the other thing is you only want to take limited risk short trades because if you just short a stock, that's very high risk because if the stock rallies and keeps rallying, you've opened yourself up to almost unlimited risk there. So you only want to take limited risk short trades, and this takes you out of the realm of risky trades. In other words, a lot of people associate short trades with a lot of risk, but if you use the limited risk trades, it takes you out of that whole category of high risk, and we'll see examples of that. And then you want to confirm the downtrend with the on-balance volume. And that's important because I've been taking some short trades lately, and I use this on-balance volume to narrow it down because I noticed some stocks, the price trend is down, but the on-balance volume line is kind of flat, so I won't take a short position if that's flat. I want to actually see that on-balance volume line trending down. Okay, these would be examples of limited risk short trades. And of course, the short trades means that you profit if the stock goes down. You can purchase put options. You can buy put option spreads. You can buy bearish or inverse ETFs. or you can do buy rights on bearish ETFs. And I'll show you examples of all these. Those are the 4 trades you can take that are limited risk that I would recommend for any short trades. I wouldn't just go short a stock because that's too high risk. So these would be examples of trades that are not limited risk: futures, forex, shorting stocks, or selling naked options. These would be examples of trades where your risk is not limited, and if you get caught on the wrong side of the market because of some overnight world event that happens, you can get wiped out in a hurry. And I know people that's happened to. So the number 1 rule is never put yourself in a position to lose more money than you invest. So with these trades, you can lose more money than you invest. And you can get a call from your broker saying, you know, you're on a margin call, I'm liquidating all your positions, and he could even say you owe me money. So you never want to be in that position. Okay, so you only want to take short positions in stocks or ETFs when the major price trend is down. Here's an example of this is the S&P 500, and right here the S&P 500 is on a buy signal because this is the 1-month price and it's above the 20-month price. So when it's on a buy signal, you don't want to take any short positions in here. Here it's on a